Hello and welcome to Making Sense of Financial Statements, presented on behalf of the Victorian Council of Social Services as part of the Clearinghouse Rural and Regional Training Program. My name is Michael McGann and I'm a Senior Project Manager for Matrix on Board, a consultancy company that works exclusively with non-profit organisations, building capacity in financial management, management support and governance. My background is in financial services, where I've spent the past 5 years working with small to medium-sized financial planning firms to help them achieve their goals and objectives. I hold a Diploma of Financial Services and a Master's in Organisation Dynamics, and at Matrix I work with CEOs and boards of not-for-profit organisations to help them to develop their management capacity through business and strategic planning. I'd like to welcome you to these training programs, which will introduce you to financial statements, some common accounting methods, and the importance of this information for boards when they make decisions regarding the current and future capability of your organisation. Accompanying this presentation is a participant manual, which can be downloaded from this site. If you have previously attended one of the workshops that were conducted, it is important to note that the presentation has been altered in structure to accommodate the short video format. However, the content is unchanged and can be found in your participant manual. In this, the third session, we'll look at cash versus accrual accounting and the value of each methodology to your organisation. Of the two methods, the cash accounting method is by far the simpler to work with and understand. The cash accounting method recognises when cash is received and when bills are paid. Quite simply, in your financial reporting, you would enter the transactions at the date when payment is made or received. Cash accounting is hopefully an accurate record of transactions, but is not a real financial picture. Cash accounting records what we earn and spend when we earn and spend it. Transactions are entered at the date payment is made or received. It reflects cash flow. A bank statement is a very simple example of a cash accounting record, as it shows all of the transactions on the day they occurred. Accrual accounting, on the other hand, records transactions when the transaction is entered into, or the goods and services are provided, even though you may make the payment earlier. The accrual method reflects the value of the obligations and commitments that have been made. Accrual accounting allows for funds to be properly matched against goods or services when they are truly used or provided, and shows a more accurate picture of the organisation's financial position. Accrual accounting allows the organisation to measure revenue against the resources necessary to generate that revenue. It also gives you the organisation's position as if it were to cease trading on that day. For example, imagine that your organisation enters into a contract in December 2009 and provides $1,000 worth of services in that same month. However, you don't get paid until January 2010. Under the accrual accounting method, you would report the $1,000 of income in December and nothing in January when it is paid. However, under the cash method, you would report the income in January. By aligning the payment to the service in December, the amounts received will reflect accurately the service provided. A general rule of thumb is that to test the financial stability of your organisation, you should use the accrual method. For reporting of GST, entities with less than $1 million turnover could use a cash method. However, if turnover is greater than $1 million, GST must be reported using accrual methods. There is more information on accrual accounting and a couple of exercises you can work through in the participant's manual. In the next session, we'll discuss how to build a budget and how budgets are used.